afternoon, everybody. Thanks for joining us today for another weekly webinar. We are excited today to have the team from Hanson Weeble back with us. They did a fantastic webinar back in, I think it was April, when all of this kind of started and the CARES Act to come out and all the different pieces, and they have stayed on top of it. They have different task force teams that have been working on the different things that have come out because of the CARES Act, Families First, PPP, all that good stuff. So we've asked them to come back and address some questions that people have had, give us a little update on what things have changed, what regulations have changed, and then of course the forgiveness pieces as this new information has come out and they've been able to stay on top of that and give us some good information. So again, this webinar is recorded as usual and we'll post it on our website later so you can access that. If you have any questions during the webinar, feel free to put those in the chat and we'll be checking those as we go. And then we'll have some time at the end for Q&A if that comes up. So I'm going to turn it over to Matt Hale with Hanson Weeble. Thank you so much for putting all this together today, Matt, and for the presentation you guys are going to give us.
All right. Well, thanks, Courtney. I really appreciate you all giving us the opportunity to share with the Chamber and your members. Like you said, we're going to go over some of the updates to the CARES Act and the FFCRA. Last time we kind of gave you a brief overview of what was out there and what was available. Obviously, things have changed. Things are continuing to change, but they've settled down a little bit. So we're going to give you a little bit more information on that. I'm not going to say it isn't subject to change again, but at least you'll have a better idea of what's going to happen and more of the how-to. How do you apply for some of these credits? How do you document it? What do you need to do as a business going forward in order to claim credit for a lot of these things? I did want to, our materials are going to be shared through our website. So I wanted to direct you guys how to get there and how to use them in the future. So just going into your Google search right here, if you just type Hanson Weeble, it should be one of the first ones that come up, coming through. And then you go to Hanson Weeble, our website. And then right up here at the top, we have Hanson Weeble COVID-19 resources. So this has a lot of information there. There's a lot of things you can do. We really want it to be a resource you can use continuously in the future. So the three topics we're going to be hitting today is we're going to be talking about some of the business credits you can get, which is going to be the employee retention credit, as well as the employer tax deferral. How do you claim those credits? The next item we're going to go through is we're going to talk about the Families First Coronavirus Response Act, which has some credits you can get for giving paid time off for people impacted by COVID-19. And then lastly, we're going to talk about the PPP and mainly the loan forgiveness portion of that. That has changed a lot. I think it's settled down. It'll probably change a little bit more, but at least you have a better idea of what you need to do going forward. So with that, I'm going to lead it over to David Harris, who's one of our tax experts here, who really likes to get into the nitty-gritty of a lot of the tax law changes, who's going to be talking about the employee retention credit and the employer deferral portion. So with that, David, here you go.
Good afternoon. So there are two provisions, as Matt mentioned, that I wanted to talk to you guys about that are related to businesses and some credits that were in the CARES Act to help them primarily, just like with the PPP, to meet their payroll, to reimburse them for keeping employees on, even if their business has been disrupted and they're not generating revenue. So the first of those is the employee retention credit. And this is a refundable payroll tax credit that a business can take when they are paying payroll to employees when their operations have been fully or partially suspended by government order. Now, that question about suspended by government order is a tricky one because there are, I had a client ask about, well, it was recommended that we couldn't do this for a period of time. And then later on, the governor came out with an order and said that, well, now you're a non-essential business, you have to shut down. At what point were we actually shut down? And really, it does come down to an order from the governor requiring you to close your business, that counts as a partial or full suspension of business. So the other option that you have, if you didn't get such a government order, you were able to continue your business, but under dramatically reduced circumstances for various reasons. If you had a reduction in your revenues quarter over quarter, so first quarter 2020 versus first quarter 2019, of more than 50%, then that would be enough also to qualify you as an eligible employer. So if you're fully or partially shut down by government order, or you have a 50% reduction in your revenue, then you can claim this credit as long as you haven't taken advantage of the payroll protection program and gotten a loan that will be forgiven under that program. So for this part, the employee retention credit, if you have applied for a PPP loan, then this is not relevant for you. So those are the kind of gatekeeper things you have to get through. And then once you're through those, then you can look at whether this credit works for you. So the next kind of decision point is how many full-time employees you have, how many employees you have. It's not full-time equivalent, it's employees. And if you are under 100 employees, then you can take this credit with respect to all the wages that you pay to your employees. If you have over 100 employees, you can only use wages that you pay to an employee when they're not working. So you've been shut down, the employees can't work, you're paying them anyway out of the kindness of your heart. And if you're over 100 employees, those are the wages that you can get a credit for. The people who are actually working, showing up at the office, whatever, those wages do not count. So that's the next decision point. So once you decide which of your employees are eligible, the final point is to look at the wages that you're paying them. So the credit is capped at taking into account $10,000 worth of wages for each employee. And these are wages paid from March 13th, 2020 through the end of the year. So for most of your employees, that's going to be at least $10,000. If it's not, in terms of salary, $10,000, then you can also take into account payments that the employer makes for health insurance for the employee. That can be added to it. So once you get to that, let's say you get to that cap of $10,000, now your credit can be 50% of that amount. So essentially the credit is up to $5,000 per employee. So the way you take this credit is you put it on the Form 941. So you had a little brief period of time from March 13th to March 31st that was in the first quarter, but you were not able to take, because of when the timing came out and the forms came out, you weren't able to take this credit on your first quarter 941 for the wages that qualified during that time period. So you take those wages and then add them to your second quarter 2020 wages and figure out your credit amount, and you take that credit starting on your second quarter 941, which is going to be due, you're going to be preparing it during July. So this is very timely. This is about the time you're going to start thinking about preparing that form.
Hey, David, for the non-accountant people out there, you want to tell them just briefly what a 941 is?
The 941 is your quarterly payroll tax return. So, you make your deposits throughout the year. Every week, when you make your payroll, you make your deposits, then you file your quarterly tax form that reports, here's how much my wages were, here's how much tax I owe, here's the deposits I made. And then now you can wait until you file your 941 and get the money back, claim the credit. You've been making your deposits just like normal, or you can withhold an amount from the deposit in anticipation of receiving the credit. So that's available to you. You just want to make sure that when you get to the end, you've paid in everything that you're supposed to pay. Now, let's say that you believe you're going to take this credit, or you did believe you were going to take it at some point in the past, and you were reducing your deposits. And so now you get to the second quarter and you realize, well, wait a minute, I went and got a PPP loan. As that program expanded, maybe I waited for the second round of PPP and I decided to apply for a loan. Now I don't qualify for the credit anymore. So now when you file your Form 941, you're going to have a balance due because you did not pay in your deposits in anticipation of that credit offsetting some of your liability. There's some relief from penalties for that. Normally those penalties can be pretty substantial when you have especially withheld money from employees' paychecks and not given it to the government in a timely manner. Those penalties can get pretty onerous. So the the part of this program is that if you didn't make those payments in anticipation of the credit and then you didn't take the credit for whatever reason, then you have relief from those penalties. So again, the decision points are, did you get a PPP loan or didn't you? And if you didn't, then how many employees do you have? Well, next point is, were you shut down by government order or not? Or did you have a 50% reduction in your revenue? So if you meet that test, then you decide whether you have 100 employees or not. And then based on that, you determine which wages you can take into account. And then you take that credit on your Form 941. It's fairly complicated. It is a nice benefit. $5,000 per employee is not nothing. But if you've got higher paid employees, it's not really a substantial offset of the cost of keeping them on, especially if you're a larger company that has over 100 employees and they haven't been working and you're still paying them. $5,000 is nice, but it's not really making you whole on that necessarily. For most small businesses, I don't know what percentage of small businesses that have employees took a PPP loan. I'm guessing it's fairly substantial. And by the way, there are still some PPP loan proceeds available, I believe. So last I checked, there was $150 billion still sitting out there. So it's not too late to apply. We've got a few days left, I believe, before that's done. So that's the employee retention credit. Complex, but most employers are probably going to be getting a PPP loan or have already gotten a PPP loan, and thus it's not going to be relevant for them. The second part of this, which is the delay of payment, the deferral of payment of employer payroll taxes, is available to everyone. That wasn't the case when it came out. When the CARES Act initially came out, that credit was only available if you did not get a loan forgiven under the PPP program. So there was some question about, well, I haven't applied for the loan yet. I've got these payments due. Can I defer the payment of those amounts due until I get my PPP loan? And that was some uncertainty. But now with the latest changes, getting a PPP loan does not impact your ability to defer the employer payroll taxes. So what does that mean? First of all, the key word there is employer. So you have what you pay on your 941 every quarter is a combination of federal income tax that you withhold from your employee's payroll, the Social Security and Medicare, the employee portion that you withhold, and then the employer portion of Social Security and Medicare. It's only that employer portion that's available for the deferral. And what you do is you take up the amount of the employer contributions, the employer Social Security and Medicare, and you just don't pay it to the government. You set it aside, and this is starting on March 27th for payments due March 27th, and it goes all the way through the end of 2020. And you aggregate all of that amount. And at the end of the year, you say, all right, I had $100,000 of employer payroll taxes that I haven't paid to the government yet. You split that in half, and you pay 50% of that amount by December 31st, 2021, and then the remaining 50% by December 31st, 2022. So it's a substantial deferral of that payment, with 50% going all the way out, almost 2 years, well, a year and a half from now. So that can be a very nice benefit. Self-employed individuals can also take advantage of this, but if you're a self-employed person, you know that when you pay your taxes on your Form 1040 as self-employment tax, and it's just all calculated as one number, but you take a deduction, an above-the-line adjustment for the amount, what is deemed to be the employer amount of that self-employment tax, which is 50% of the total self-employment tax. That's treated as the employer portion, and that's the portion that you can defer payment of on your Form 1040 for this year, and then make that payment in 2021 and 2022. So the only other wrinkle with that is that if you're using a third-party payroll provider and they are actually functioning as they're writing the paychecks, but you are still treated by law as the employer. If you tell that third party, hey, don't pay my employer portion of my payroll tax, I'm going to defer that payment, and they do so, then when the time comes in 2021 and 2022 for that payment to be due, that third party is not responsible for making that payment. You as the actual employer are responsible for making that payment. So that's the two programs, employee retention credit and the deferral of the employer payroll taxes. I think many, many more people will be taking advantage of the deferral. Do we have any questions, Matt?
Well, look, Kim, do you see any questions on that? coming through. I think one thing to keep in note is the payroll taxes. I mean, you do owe that, and you're going to be responsible for that. So you need to keep track of that when it's due. And just remember, I mean, from a cash flow perspective, you want to think long and hard about taking that, because if you have the cash to pay it now, and you might not 2 years down the road or whenever it's due, I mean, that's part of your consideration to come through.
And because it's a payroll tax, I haven't delved into this, but I would suspect that the same special provisions for responsible persons apply. So even if the company goes out of business and you deferred these payments, then if you were the responsible person for making that payment, even if the company has gone out of business, you could still be responsible for making that payment. They don't let go of those, what they call, what's the term? Trust fund payments. Because that's really Social Security and Medicare, especially if you've withheld it from the employee, but even the part that you owe as the employer, they don't take kindly to that not being paid. So they can go after you through even if the business is no longer in business.
So, Kim, did we have any questions come up?
I'm told there are no questions.
I was going to say no questions. I think you guys are doing great.
All right. Now, I do want to point out, and as David has alluded to, I mean, this does get complicated, and if you do have questions after this is over with, feel free to reach out to Kim or Courtney or someone at the chamber. They can give you my contact information. But additionally, on our website, we do have these items. Fill out the form for more information. You can put your name, your email address, the subject, and a message, and we'll get back to you as soon as we can. So even if the questions come after this presentation, don't feel like it's over and it's done. We're here for you guys. Let us know what you have. So, well, David, thanks so much for that. I appreciate it. With that, we're going to move on to the FFCRA, the Families First Coronavirus Response Act. We have Kim Martin, who is our HR expert and administrator director here at Hanson Weeble. She's dived pretty deep into this. She's always on top of it, and she's definitely a go-to source for a lot of things, not just this. We all appreciate it. So with that, Kim, take it away.
Awesome. Hi, everybody. So the Families First Coronavirus Act is meant.
Yeah, I think, Kim, we can't hear you.
So sorry.
Oh, there we go.
So the Families First Coronavirus Act is meant to be a bridge for employers that less than 500 employees that don't have either robust sick time, or maybe for employers that don't have sick time at all. It allows for people who have COVID-19 symptoms to be able to take up to 10 days off if they're unable to telework or work due to specifically COVID-19 and they have documentation to support that, or to care for family members that may need help with that, or if a child care issues, not just because school is out, but because if there was a summer camp or something they were meant to go to is no longer available. So they've come out with a little more detail about how we support the documentation, which is important. So if the employee needs to be off for sick time, they need to have a doctor's or from the doctor's office support. Before they were saying, when this first came out, not to worry so much about that, but they are now requiring documentation. The employer needs to document that the employee requested it, that they have proper documentation, and they also need to provide substantiation for why it was approved or denied. Those records should be kept for 4 years in case of an audit. The same goes for other pieces. If you have to care for somebody else, it's paid a lesser rate, but you still have to have the chain of the approvals and why or why not it was approved or denied. You also need to maintain documentation as to how you determine a wage. If it's not a salaried employee, how did you decide what wages are included? And note that you're allowed to deduct healthcare expenses during those windows. So it's important to know, how did you come up with that? Usually it would be how much is their coverage for the year divided by how many days in the year, and then that per day. You just need to make sure that you have full details of what that looks like. So of the 6 reasons, ones are pretty straightforward. If somebody is ill, they have that 10 days because they should be quarantined for 14 days. That's kind of easy. They can be paid up to $511 a day for that time frame. You've got that documentation to support it. You're able to submit for reimbursement for that. You can, on your 941, which is where you submit your taxes quarterly, you can withhold the wages, including the healthcare costs that you paid to that employee. Or if you don't think you're going to have, you're not going to be paying it enough for your quarterly tax payment, you can file a 7200 to request that you get that reimbursement ahead of time. The IRS is saying that they'll turn it around in about 2 weeks. I don't know that I would completely count on that, but ideally you would get it back fairly quickly. The other thing I think that keeps tripping people up is the childcare. You know, now that things are reopening, but you're finding that overnight summer camps are not happening. In order to qualify for the FFCRA for childcare purposes, it's that their childcare provider or place of childcare is not available. So now that school is done, if they're normally home for the summer and don't have other plans, that isn't a reason. But if they were going to summer camps, or you have a daycare that you send them to or something of that sort, and that isn't available, that becomes a qualifying reason. So it's important to try and maintain some flexibility, but it's also important to make sure that you have a clear understanding of what the employees are requesting and what they need to make sure that it qualifies. If a child is 14 years old and you need to verify why they need childcare between age 14 and age 18, and you have to have substantiating reasons, and the employer has the right to approve or deny it. If the child is over 18, the only way that you can qualify for FFCRA is if they have a disability and they need to have regular constant care. It follows the same rules that you need to make sure that you're keeping documentation, the child's name, where they go to school or their place of care, what the reasoning they need support, that you have proof that the school is closed or the place of care is closed, or their normal caretaker, nanny, whatever the case may be, is not available. And then you can give that employee, they can use that 2 weeks of emergency sick time, and then they can qualify for expanded FMLA. The big thing to remember with FMLA is it's once in a 12-month period, whatever your particular qualifying period is. So if they've taken it previously, they can't take it again. You can combine the sick time with the expanded leave, but the bucket of the 2 weeks is once it's done, it's done. So if they're either using it for themselves because they're ill, or taking care of somebody else, or childcare, it's a 10-day window. Once it's over, it's over. So they can qualify for 2/3 pay up to $200 per day. Again, you need to have great documentation, exactly what you're paying out. I would suggest that you have separate payroll codes to track everything to make it much easier, and keep all of your documentation for 4 years, just in case there's any questions. They haven't changed a lot of it. When they first came out with the act, they didn't give a lot of information in detail. What they finally did is explain more of what it looked like and what it meant. There are some fairly flexible gray areas that leave it open to interpretation, but what the Department of Labor has asked is that employers work with employees. This is supposed to be for the greater good. It's supposed to keep your employees there. It's supposed to keep them engaged, and it's supposed to help through difficult times. And so it's to everyone's advantage to support them during that transition or during these difficult times. And if anybody has any questions, you can always fill out the form at the bottom of the article, and any information I can provide, I would be happy to help.
Great, thanks, Kim. Yeah, some of the key takeaways are you need the documentation for it. You're going to apply for the credit on the quarterly payroll tax return, the 941 and whatnot. And if you have any questions, it gets complicated, feel free to reach out to us, and we'll get you the information you need on that.
The biggest major takeaway is documentation. You want to be able to justify why you did what you did and the process you took to get there. And that can be a little bit confusing. So absolutely, any questions, let us know.
Great, thanks, Kim. I really appreciate it. All right, so the next item we're going to talk about is the triple P. Now, this has definitely been a moving target for a lot of people coming through. And with that, we have Chris Brubaker. He is a partner here at Hanson Weeble. He's kind of a jack of all trades. He's an expert in a lot of stuff, does a lot of business valuations, as well as our advisory services. So as we were going through, this is definitely one of the value adds for our clients that Chris focused on is the triple P. How do you obtain it, and the loan forgiveness portions of it, which has been kind of difficult over the past little bit. So with that, Chris.
Thanks, Matt. And I guess before we get started, just to kind of reiterate something that David said earlier, the deadline to apply for loans under the program is June 30th. So I'm assuming that most people who are interested have already applied. But if you have not, or if you know someone who qualifies who has not, you've got a little bit less than a week to take advantage of that. Last I heard, there is still a fair amount of money left there, so that's something that's available to borrowers if it will be helpful. What we want to focus on today, though, again, assuming that most people who are interested have applied and are coming up on, or maybe have already reached the time when they're through at least their initial period for their PPP funding, is the forgiveness provisions. And I think if you would scroll down through what we've done, we've posted a ton of things on this program. I'm sorry, Matt, you don't need to do it right now, but because it has changed more or less twice a week, I think we've put all kinds of information up on our site. What we wanted to do today and focus on the forgiveness piece is this last article we wrote on, we posted actually just this morning, that kind of is an overall summary. It's tough to cover everything, but I think this really is pretty comprehensive of the loan forgiveness provisions. And so this takes into account the Paycheck Protection Program Flexibility Act, which Congress passed back in early June, that made pretty wholesale changes to the program, as well as the applications that the SBA released just last week. And so we're summarizing those things, and we've kind of, again, got everything, as much as we can at least, into one area to kind of summarize all the forgiveness provisions. So we'll kind of walk through this. I apologize, it's a bit dense. I'll try to cover everything without getting into any more detail than will be necessary. So the first step is to look at what the eligible expenditures are. And those really break down into two categories. One's payroll cost, and the other is non-payroll cost. It really is a payroll guided program, and so the payroll costs are really what's going to be most important. Those have really three components. They're just kind of salaries and wages. That's capped at $100,000 annually per employee. We'll see as we get below, there are some differences there too if you're looking at employees who are also owners of the business. That'll be the biggest component, but then there's also some benefit provisions. First is healthcare cost, which that really is just health insurance. You exclude in that case self-employed individuals, partners in a partnership, and also S corporation shareholders. If you're a shareholder of a C corporation, you can still include your health insurance costs there, as well as the health insurance costs for any other employees. The next benefit that's available is retirement benefits, which is really it's the employer's part of any kind of 401k or SEP or simple plan payment. And those you're again going to exclude any payments made on behalf of partners or for self-employed individuals. And then lastly, and this is not going to be a very big number, but it's state and local taxes on employees' wages. That really, for our purposes, particularly those of us in Virginia, is really just going to be state unemployment tax, which it's a small number, but it's something to include. And so those are really kind of the eligible payroll costs. And again, I said there's going to be some differences where you look at for business owners. And this is a new provision that's been kind of working its way through some of the SBA's rulings as far as how these owners compensation is handled. Basically, we're going to talk about coverage period here. We'll get more into what a covered period is down below. That's going to be an important an important provision that will come into play in a lot of areas. But you can use either an 8-week or a 24-week covered period. If you're using a 24-week period, which is the default now, the most compensation you can include for forgiveness for any owner, and that includes C corporation owners, S corporation owners, partners in a partnership, or self-employed people, is $20,833. If you use an 8-week period, you can use a $15,385 limit. Now, where do those numbers come from? The 15, we mentioned up above that compensation's capped at $100,000 per employee. If you have an 8-week period, so if you divide 8 by 52 weeks in a year and multiply that by $100,000, that's where the $15,000 number comes from. Now, why is the 24-week number not 3 times that? The reason is the $20,000 number is 2.5 divided by 12. And so if you'll remember back when we had the first application for PPP loans, it was based on 2.5 months of salary in 2019. And so the theory, SBA's and Treasury's theory in setting this $20,000 limit is that an employer who applied for this would not have used more than $20,833 of his own compensation in making that application. And so their theory was if they allowed an employer to use more than that number for forgiveness, it would kind of be a windfall to employee owners. And so that's why that funny number is there as that cap. So again, those are just special numbers for owners. The next paragraph there, as I said, this thing changes every day. There was just guidance. The SBA kind of contradicted itself between its earlier guidance and the application. There was just guidance issued Monday or Tuesday that actually does conform now. So you can, if you read this on your own, and I feel for you if you do, but it will, you can just ignore that paragraph because those are all now in line with each other. Okay. So that's the payroll cost piece. Looking at non-payroll costs, there are really 3 categories there that are eligible for forgiveness. The first is mortgage interest, which that is interest on loans that are secured by either real or personal property used in a business, as long as those loans were in effect as of February 15th of 2020. And again, it's just the interest piece. It's not any principal payments. The second is rent. And again, that's for rent for real or personal property. The lease had to be in effect as of February 15th, 2020 as well. There were some questions for a while about whether that rent could include rental to an owner, right? So if an owner owns a piece of real estate, say, and leases it to the owner's business, is that eligible rent? Everything that I've seen, everything that I think the thinking is now, is that is eligible for forgiveness as long as the lease was in place as of February 15th. The last category is utilities. And the SBA has defined that, and I think actually it's in the CARES Act as well. The definition includes electricity, gas, telephone, water, internet access, and then transportation, which is kind of a funny one to me. There's not a lot of guidance as far as what transportation means. The SBA in one of its early releases made a brief reference to fuel for a business vehicle. That's all that I've been able to see. I don't know that that's going to be a real big issue for anybody. I think what I would advise, if it comes up that you need more expenses and you have some other costs that you might reasonably call transportation cost, I think the option is either to discuss with your lender how they'll process the loan and whether they would accept those, or maybe even just to include them in your application and let the lender deal with it as they process your forgiveness application. But again, that shouldn't be a big issue, I don't think, for most borrowers. Okay. Now, as far as the timing of these things, I mentioned above that this covered period is really an important concept in a lot of areas. The covered period is really the period when you have to expend your PPP funds to have them qualify for forgiveness. And the law as it stands now after the PPP Flexibility Act is that the covered period is 24 weeks, and that begins on the date that the borrower first received PPP funding. That supersedes the previous law, which was the initial law under the CARES Act, which was there was an 8-week coverage period. And the theory there, I mean, there were a lot of companies that were going to have some trouble, particularly those who had not been able to operate at full capacity. You know, they may not have been able to use all of their PPP funds during that 8-week period. And so they wouldn't have been able to have the entire loan forgiven. And so that was why that period got extended to 24 weeks. You know, that to me seems like it's pretty long. I mean, there was talk of doing it for 12 weeks or 16 weeks, but it ended up being 24. So that's kind of the default now is 24 weeks. Now, if you had borrowed, if you had received your PPP funding before June 5th, which was the date of the Flexibility Act, you can make an election to use the 8-week period rather than the 24-week period. And I think what we've seen from analyzing it, that may be a good option for people, you know, where you're able to qualify. If you're able to make enough expenditures during the 8 weeks to qualify for forgiveness, it probably is better to just go ahead and apply rather than waiting for the 24 weeks. There are some drawbacks. I mean, the 24 ought to help a lot of people meet their expenditure goals where they may not have otherwise. But there are some potential drawbacks to that we'll discuss as we go further along. So if you can do 8 weeks, 8 weeks is probably better. And then just the paragraph below that, it talks about that you can have a special, it's called an alternative coverage period for payroll. It may not be something that a lot of people want to use, but you can start your payroll, your coverage period rather, just for looking at your payroll costs on the date that your first pay period begins after you receive your PPP funding. And again, there are some other provisions in the Act that make that not as useful as it may otherwise have been, but it is there, so we wanted to include it just you know, in the interest of being complete with our guidance here. So those are really that's kind of the expenditure side, and that's really the first step in determining the forgiveness. I mean, that's sort of after you've gone through those steps, that's the most that you can have forgiven. The next step, there are some provisions that can reduce that amount once it's determined. So we'll talk about what those are, and if you are running into those, some options for getting around that. So the reductions really are based on maintaining your staffing and compensation levels during your covered period. And there are two main categories there. One is there's a reduction based on salaries paid and hourly wages. To calculate that, you look at what your average salaries were during your covered period. So again, that's either the 8-week or the 24-week period beginning when you receive your PPP funding. And then you compare those hourly wages and salaries to what they were for the first quarter of the year. So that's January 1st through March 31st of 2020. And if there's a reduction, then you may have to reduce the amount that you can have forgiven under the PPP program. Some important things to note here, this is a per employee test. And so you're going to have to look at each employee individually and see whether that employee's compensation was reduced. An important thing to keep in mind there is you don't have to take into account anybody who made over $100,000 on an annualized basis in 2019. So what that means is if you look on a pay period by pay period basis there. So if someone, say you've got a bi-monthly pay period, if someone made enough in one pay period, and if you would have multiplied that out for a whole year, if that would have been $100,000 or more, then you can ignore that person for this computation. You're also going to ignore anybody who is an owner employee. So that again is corporate shareholders or partners or self-employed people. So you're looking at really just kind of actual employees who are not owners, who did not make $100,000 or the equivalent of $100,000 in any period last year. There's also a bit of a cushion there, so you can reduce someone's payroll or compensation by up to 25%. So you're really looking at their compensation during that measurement period, the first quarter of the year, times 75%. As long as you're paying everybody at least that amount, then this reduction is not going to apply. Okay. If it does apply, then it's really a dollar for dollar reduction. So if I did reduce say I'm an employee and my salary is reduced by 30%, then that 5% difference between the 25% and the 100%, that is a dollar for dollar reduction in my employer's forgiveness level. Okay. So if you do find yourself in that situation where you've reduced someone's compensation, there's a safe harbor for that. It allows you to restore the employee's compensation to its level of February 15th, as long as you do that by one of two dates. I mean, the way the law is written, you have to restore that by December 31st. Knowing that's a long way away, the application and the SBA's guidance allows you to use a shorter period, which would be the date you apply for forgiveness for your loan. So if I apply, say my covered period ends on July 31st, if I apply on that date, then that's the date when I have to restore my employee's compensation to be able to meet that safe harbor. And if you meet the safe harbor, then you can ignore the reduction. So that it really does kind of provide a good opportunity to avoid this test for borrowers who may have had to reduce some compensation for some employees. Okay. The second test is really kind of a headcount test. It's based on the number of full-time equivalent employees that a business has. What the full-time equivalent means is it's based on a 40-hour work week. So you're going to look at each employee's hours or his average hours over the coverage period, divide that by 40. If it's 40 or more, you can't have more than one, employee can't be more than 1.0 FTEs. And so if it's 40 or more, you have one FTE. If it's below one, so say I work 30 hours a week, you have a choice. I mean, you can either treat 40 hours a week as being 0.75 FTEs, or for simplicity's sake, you can look at anybody who worked less than 40 hours and call them 0.5, so a half of an FTE. That may or may not make a difference. I mean, it's something to play with maybe if you're running into this reduction, but for simplicity's sake, you can really just think of everybody as either being one full-time equivalent or half of a full-time equivalent. So you add up all of your average full-time equivalents during your coverage period. And again, that's either the 8-week or the 24-week period that you choose. And then you're comparing that to one of two different reference periods that the borrower gets to choose. The first is February 15th, 2019 through June 30th of 2019. The reason those dates are there, I guess, are just that it kind of corresponds to the original period where the Paycheck Protection Program was supposed to apply. Then there's an alternative to that. You can either look at the beginning of 2020. So you can go from January 1st of 2020 through February 15th of 2020. The borrower can choose whichever one of those is more beneficial and compare the number of FTEs during that reference period to the number of FTEs in the covered period. If the number in the covered period is less, then you take the percentage difference, and that reduces your forgiveness. It's important to note here, there's not really a cushion like there is above with the compensation test, where it has to be at least a 25% reduction before it affects your forgiveness. This is just from the get-go. If I reduce, say I've got 10 employees, if I reduce that to 9 employees, then I have a 10% reduction in my forgiveness right offhand. So it can be, it's something that the employer could hit pretty easily. I think for that reason, there are several ways to either get out of it or reduce it, which we'll kind of go into a little bit here below. The first, there are a couple of exceptions, and these really reduce the reduction. The first is if I have an employee who I have to let go of for some reason during my covered period, if I make a good faith written offer to rehire that employee and he rejects my offer, then I don't have to count him. So, I mean, the reason this is there, I think a lot of borrowers or a lot of employers are aware that with the increased unemployment benefits, for a lot of employees, it's been better off to be collecting unemployment than it is to work in some cases. And so this kind of helps the employer there, where they're just having a tough time finding somebody to fill a spot. The other exception in this area, which is kind of similar, If I terminate a borrower for cause, I don't have to count that that employee, or if the employee just willingly resigns or asks for a reduction in hours, I don't have to count that employee either. Now those exceptions only apply if I don't fill the role. So if I have an employee, he decides to go take another job, so he leaves me, but I'm able to fill that role, then I'm still supposed to count that position as an FTE in the testing. So again, those will just, that kind of goes employee by employee, so it can reduce your forgiveness. It doesn't get you out of the test altogether. There are 2 safe harbors, however, that will get you out of the test entirely. The first of those, and this is new under the Flexibility Act, if the borrower can document that from February 15th through the end of its covered period that it was not able to operate at the level that it was operating before all of this happened, before February 15th, and that decrease in the business was because it was complying with rulings or with guidance from the Department of Health and Human Services, the CDC, or OSHA related to the COVID crisis. If you can make a good faith documentation of that, then you don't have to do the FTE reduction at all. And the good thing here, I mean, this is interpreted pretty broadly. I mean, that was part of what the most recent SBA guidance said, is that, you know, you look at those 3 organizations, you might think, well, hey, was my reduction really because of what those organizations said? The SBA has come out and said it doesn't have to be directly related to those organizations. That if the governor, for example, said that your business was not essential and that you were unable because of government rules to operate during your covered period, and that was based on the guidance from these other organizations, then that will qualify. So really anybody who's been shut down at some point or has seen business reduced because, again, they were complying with government mandates, this ought to be kind of a get out of jail free card and prevent you from having to deal with the FTE test. The last of the exceptions is really pretty similar to what we talked about above with the compensation. If you did have a reduction in FTEs and you're able to restore that reduction by the time you apply for forgiveness, then you can get out of that test as well. So again, that's pretty similar to what we talked about above as far as compensation. So going through those, I mean, that really is kind of how you get to the amount of your loan that'll be forgiven. Want to look also, since we have a new application, excuse me, and we have more guidance on how the application actually works, just kind of what that process is. The application says that that a borrower has to apply within 10 months of the end of the covered period. So again, there's the covered period again coming back into play. But it gives you a long time, right? So I mean, if you're deciding whether to apply using the 8-week covered period or the 24-week covered period, you have some leeway there. So you can, you know, at the end of the 8 weeks, you can look and see what your forgiveness might be. You can wait till the 24 weeks is up if you want before you apply and just see if it would be any better for you at that point, and then apply for whichever one is better. But again, the 10 weeks is nice because it gives you some time before you have to get your application in. Again, in the most recent guidance from the SBA, they even said that you can apply early if you'd like. I think everybody was thinking before, because the covered period really, your compensation and your FTEs during that covered period are important. The thought was that you had to wait until the covered period was over before you could apply. The SBA has said that you can apply before the end of the covered period once you've spent all of your funds if you want to. Although if you've had a reduction in your employees or in your compensation, you have to apply that reduction as if it applied for the whole covered period. So that'll be that probably is a drawback. So again, it's something to look at. I mean, if you come to the end of your PPP funding, if you haven't reduced your compensation, if you haven't reduced your head count, it may be a good idea just to go ahead and apply. And that's a new option under the most recent SBA guidance. We have links on our website to the applications. There's an application, there's a kind of a long form application that's several pages, and there's a simplified application that we've linked to for both. The distinction between the two, which I don't know that we included here, is really those two tests. And so if you're going to need to deal with the FTE test or the compensation test, then you need to use the regular application. The simplified application, by filling that out, you're kind of making a statement that I've maintained my headcount, I've maintained compensation for all my employees, and so those tests are not going to apply to me. If they don't apply, then the forgiveness is really kind of simple, and so you can use the short form application in that case. And so that's really the distinction between which of those you'll use. And then for both, there's guidance on what to include with your application. Again, most of this stuff is payroll related because again, the program really is payroll driven. You'll need to include either bank statements or payroll service statements to support your compensation during the covered period. You'll also need similar documentation from the first quarter of the year and also from whichever of the reference periods you choose if you are subject to the FTE test to be able to support your number of FTEs and your compensation per employee. I would hope, and I haven't seen the document itself. I saw something that Paychex was going to put out some documentation to support this. I would think that if you're using a third-party payroll provider, that they will have reports that will satisfy the documentation needs. If not, they're certainly missing an opportunity there to be of service. But, hopefully you'll be able to get that from your third-party provider. But if not, let us know or let someone know. We can help you out with what you will need to attach for that. So that will cover most of the payroll side. You'll also need to include either statements or account or invoices or canceled checks if you have health insurance or retirement benefits, because those are also going to be included in the payroll cost amount. Looking then at the non-payroll costs, just for mortgage interest, there's kind of an option there. You can either use canceled checks and a copy of the amortization schedule from your lender. What probably is going to be a lot easier if you have account statements from your bank or whoever your lender is from February of 2020. And the reason for that is just to show that the loan was in place as of February 2020. And then for all months during your covered period and 1 month after your covered period. If you have those account statements for all those periods, that's probably the most easy thing to include with your application. Similarly for rent, you can either include a lease and then canceled checks, or if you have account statements from your lessor that will show that the lease was in place as of February and that you made your payments during the covered period and for a month after that, that'll suffice to document your rent expense. And then utilities, again, you'll need something from February 2020 just to show that that your service was in place as of that time. And then for your covered period, you'll want to attach either account statements or canceled checks or both to document what your expenses were that are eligible for forgiveness in the covered period. This could be important maybe for some people. Now, the SBA has come out and said that they're going to audit any borrower who received more than $2 million under the program. And so, if you receive that much, certainly you'll want to be sure that you've got everything in line. But even if not, even for most of us who've received less, the SBA's guides is that you have to maintain all the documents to support your initial PPP application as well as your forgiveness application for a period of up to 6 years from the time that either your loan is forgiven or you've repaid the loan. And that you have to make those documents available to the SBA or to any of its agents who are doing inspections at the SBA's request. And so that's just something to keep in mind, to keep those documents as you're going forward. And then down below, the application does list out a few specific items that you'll want to keep. You're not supposed to submit these with your application, but any documentation of any reduction in salaries or wages, or documentation of your people who were paid more than $100,000 in 2019, If you did have a reduction in your business so that you're not going to use the FTE reduction, you need to be able to have some documentation of that just in your files if the SBA should ever come and ask for those. And then just kind of the nuts and bolts of how the application works. You'll file the application with your lender. The lender does some work with it. I mean, they're not going to come back and verify your numbers, I don't think, though they will maybe come and ask questions if something in the application doesn't make sense or if it looks like you're missing some support. And then the lender will take that application and submit it to the SBA, which will have final say on whether the loan will be forgiven. The SBA then communicates with the lender, who's kind of playing the middleman in all of this, and the lender will let you know whether, one, your loan's been forgiven and you're free to go, or it hasn't been completely forgiven and you'll have some loan amount to pay back to the lender. And then you have to begin paying that back once your lender lets you know. So that is kind of a summary of this. And again, I apologize for the length of it and the kind of the density of it, but we think it is pretty comprehensive as far as the forgiveness rules go. And if you have any questions about anything in the 5 or so minutes we have left, I'd be happy to try to answer them.
So, thanks, Chris. Kim, do you see any questions that have come up? Or I know there was a lot of information there.
Yeah, there's no questions in the chat. I think I did have one, though, back to the portion that Kim was talking about with the employer credits for employees if they're out ill or whatever. Do you all know how that's going to work once school starts? Because I know childcare was part of that. If the kids are going just 2 days a week, is that going to be covered for those other couple days if the parents don't have childcare? Do you know how that's going to work?
So they haven't really answered that yet. I would suspect so, because it falls into the same category if it's due to what would normally be a regular circumstance of school 5 days a week as opposed to the 2 or 3. I suspect they'll have more guidance as more and more school districts come up with what the final plan's going to be. At a top level, I think they're going to have, yes, what exactly it'll look like. Stay tuned.
Okay, I know that's been a huge issue and things people are talking about is the child care issue in school and what's going on there. So awesome. Well, I don't see any other questions. Thank you guys so much. This was so helpful. There's so much information and things changing rapidly. We were commenting on all the different updates that you all have done and sent out, and we're just thankful that there are experts like the team over there at Hantzman Weevil that are keeping us updated on this. I know for myself personally, being very grateful that Matt is our board chair this year because he has been just such a wonderful resource. So thank you all for joining us today. Again, this will be posted on our website a little bit later. You can share it out from there or our Facebook page. Everybody have a great day. Thank you again. We hope that we'll see some of you at our first in-person Business After Hours tomorrow night. That's going to be a lot of fun. We're looking forward to it. So have a great day and thanks again.
Great. Thanks, Courtney, Kim, Shasta.
Bye.
See you guys.